Welcome to this explainer on the new Income Tax Act 2025. Today, we're zeroing in on the critical updates to rent deductions under Section 134. Let's dive in.
Imagine this practical situation. You're a self-employed professional, a business owner, or maybe an employee with a salary structure that just doesn't include a house rent allowance. You're paying a pretty hefty amount of rent out of pocket every single month just to keep a roof over your head. Now, without an HRA, a lot of taxpayers mistakenly assume they're completely out of luck. And honestly, that oversight leaves some significant tax savings on the table year after year. Well, in this explainer, we're going to break down exactly how you can claim a deduction for the rent you pay under the brand new framework of the Income Tax Act 2025.
Here's our quick roadmap for today. We'll cover an introduction to Section 134, understand the legal provision, walk through a practical taxation example, look at compliance and Form 31, discuss common practical issues, and finally, summarize the key takeaways. Section 1, Introduction to Section 134. So for you seasoned tax professionals and CA students out there, adapting to the new tax code is really all about understanding the bridge between the old and new regimes. If you're super familiar with the 1961 Act, you'll immediately recognize this deduction as the old Section 80G. Well, under the new 2025 Act, that exact same relief provision has been migrated over and updated to Section 134. But it's not just the section number that's changed. The entire compliance ecosystem around it has been modernized. The old procedural framework under Rule 11B, that's now governed by Rule 65. And that legacy physical or digital form you used to file, Form 10BA, has been totally replaced by the streamlined Form 31. Grasping this mapping is absolutely crucial as your starting point for compliant filing. Section 2. Understanding the legal provision. Okay, so what's the core objective here? Section 134 is designed to provide an equitable measure of relief to resident individuals who are spending their own post-tax income on housing. But, and this is a massive but, there is an absolute, non-negotiable golden rule. You must not receive any house rent allowance from an employer. The wording of the law is incredibly strict on this. If you receive even a single rupee of HRA, you are completely disqualified from claiming relief under Section 134. It's strictly an either-or scenario. Those two benefits can never overlap in the same tax year. Now, if you do qualify, your deduction is carefully limited to the least of 3 specific criteria. This is basically to ensure standardization across different income brackets. First, there's a fixed maximum limit of 5,000 rupees per month. Second, the deduction cannot exceed 25% of your total income for the tax year. And third, it's limited to the excess of rent paid over 10% of your total income. You have to calculate all 3 of these figures, and the law limits your allowable deduction to the absolute lowest of the 3. This mechanism makes sure the benefit stays proportionate to both your earning capacity and your actual out-of-pocket rent. So, because of that 5,000 rupee monthly cap we just talked about, the maximum absolute deduction you can claim under Section 134 in any tax year is strictly capped at 60,000 rupees. No matter how high your business income is or how insanely expensive your city rent might be, 60,000 rupees is the immovable ceiling. Why? Well, it acts as a vital policy safeguard. It prevents high net worth individuals from claiming massive deductions on luxury rent, keeping the relief targeted squarely at the middle income taxpayers who actually rely on it. Beyond the math, there are some pretty strict ownership exceptions you need to watch out for. You absolutely cannot claim this deduction if you own any residential accommodation in the city where you currently live or where you work. And here's the kicker. This ownership rule applies collectively, so you're disqualified if your spouse, your minor child, or your Hindu undivided family owns local property. The law assumes you have access to that housing. Furthermore, if you own a house in a completely different city and you're claiming tax benefits for it as a self-occupied property under other provisions, you cannot simultaneously claim Section 134 for the rent you pay in your current city. Section 3. Practical taxation example.
Let's bring this to life with a very typical taxpayer scenario. Imagine a freelance tech consultant. This consultant has a total adjusted income of exactly 5 lakh rupees for the current tax year. Because they live in a Tier 2 city, they're paying a reasonable rent of 10,000 rupees per month. That brings their total verifiable annual rent paid to 1,20,000 rupees. And importantly, to clear our first hurdle, because they're self-employed, they receive 0 HRA.
Let's run their numbers through our 3 mandatory statutory conditions. Condition 1, the statutory maximum cap is a flat 60,000 rupees for the year. Condition 2, 25% of their 5 lakh total income equates to 125,000 rupees. Condition 3 calculates the excess rent, their actual rent paid, which is 1.2 lakhs, minus 10% of their income, which is 50,000. That gives us 70,000 rupees. The law dictates we have to take the lowest figure. Taking the least of these three amounts means the allowable tax deduction for our freelance consultant is exactly 60,000 rupees. Simple enough, right?
Moving on to Section 4, Compliance in Form 31.
You know, understanding the legal math is really only half the job. Strict procedural compliance is just as critical under the new rules. Compliance now revolves entirely around the newly simplified tax year concept. The old 1961 system used to confuse a lot of taxpayers by separating the previous year when income was earned and the assessment year when it was taxed. Well, the Income Tax Act 2025 elegantly merges these into a single logical reference period called the tax year. So income earned and rent paid between April 2026 and March 2027 is simply documented and filed for tax year 2026-27. To actually claim your Section 134 deduction, Rule 65 says you must properly file Form 31. You can't just plug a random number into your tax return and expect it to go through. You need documented proof. You have to maintain your rent receipts, track your payment details like check numbers or UPI transaction IDs, and record your landlord's full legal name and address. Crucially, if your annual rent exceeds 1 lakh rupees, grabbing your landlord's PAN is absolutely mandatory. And a quick warning for practicing professionals. If the PAN you report on Form 31 doesn't match the landlord's data in the Annual Information Statement, or AIS, it will automatically flag the return in the new digital portal. The digital process for filing Form 31 is highly structured to prevent errors. Basic stuff like your name, your PAN, and the tax year will automatically pre-fill based on your login. Then, you'll sequentially enter the property address, your payment particulars, and the landlord's verified details. Once the data entry is done, you finalize the whole thing with a mandatory e-verification step. It's super simple, authenticated securely using an Auth OTP or a registered digital signature certificate. Let's look at Section 5, Common Practical Issues. Despite the law being pretty clear, we see claims rejected during processing for a few really predictable reasons. The most common error? A salaried taxpayer trying to claim Section 134 just because their actual rent paid is vastly higher than their meager HRA component. As we covered, any HRA whatsoever is an absolute disqualification. Another super frequent error is claiming the deduction when the spouse legally owns a local residential property, which violates that strict family ownership rule we discussed. And finally, too many taxpayers just forget the mandatory PAN requirement for annual rents over 1 lakh, which causes their Form 31 to fail validation instantly. Now, here is a related compliance trap that catches a lot of folks off guard. If you are an individual and your monthly rent exceeds 50,000 rupees, you trigger a completely separate obligation under Section 393, which is the new equivalent of the old Section 194 IB. Even as an individual, not subject to a tax audit, you are legally required to deduct a 2% TDS from your landlord's rent payments and deposit it with the government. Failing to comply with this interconnected TDS rule while claiming Section 134 will lead to severe interest and penalties. So, always evaluate the big picture when rent crosses that 50K monthly threshold. And finally, Section 6, Summary and Key Takeaways. To quickly wrap this up, Section 134 of the Income Tax Act 2025 offers a structured, reliable relief mechanism that totally replaces the old 80GG. Just remember, the math will always legally cap your maximum financial benefit at 60,000 rupees per tax year. The deduction requires the digital submission of Form 31 under Rule 65, and it strictly excludes anyone receiving HRA or anyone with an immediate family member who owns residential property in their city of work or residence. Your biggest asset here is proactive documentation. Don't wait until the high-pressure filing season begins, right? Start meticulously gathering your monthly rent receipts now. Verify your landlord's PAN well in advance, and get comfortable with the simplified tax year workflow. Just ask yourself, how many of your clients or peers are silently paying rent without claiming this relief, simply because they don't know the rules have changed? Thank you for watching. Please like, subscribe, and share. Disclaimer, this video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.